And start yelling at you. There we go. Oh, man, that got recorded, didn't it? Hello, everybody, Jake and Gino here, and today we are discussing cap rates. Woo! This is going to be a snoozer. And specifically, what is a cap rate? I'm kidding. This is actually something that's very important if you want to invest in multifamily housing. And gang, this is one of the things holding would-be investors back, early on in their career. The lingo, the multifamily investing cap rates and waterfalls and IRR projections. This is the stuff that everybody's talking about. And if you're new to the space, you might be scratching your head saying, this sounds foreign to me. By intention, maybe, who knows? So what do we do here? Well, we bring in the G-Daddy to break it down for us. So, Gino, how's it going today?
I'm doing good, Jake. And I thought you were going to give the definition because every time I say something about cap rates, we get all the haters coming out. And to me, it's very interesting.
Take this, haters. I don't care about cap rates.
Woo! Before I let Jake give the definition of the cap rate and even the formula, I want to mention two things about cap rates. There's an inverse relationship between cap rates and prices. When a cap rate drops from, let's say, a 10 cap to a 9 cap, the price goes up. So as cap rates drop,
it's really important. Yeah.
Price goes up. It gets very expensive. It seems counterintuitive. And I would say to the cap rate.
Say that again, Gino, because you went over that kind of fast. I think this is something that early on people don't realize, and it's very important. Hit that again.
Sure.
Real slow.
So cap rates, when they tend to drop, prices rise, and vice versa. When cap rates are rising, prices drop. And to me, when I look at a cap rate, and I'm going to give you a number, for instance, a 10 cap, and I'm looking at that versus a 5 cap, the first thing that comes to my mind as an investor who's been investing in years in multifamily, that 10 cap market is more risky than the 5 cap market. Because in multifamily, in any income producing real estate, you are buying a future stream of revenue. So the 10 cap property is priced cheaper. There's the price cheaper. So you can look at two markets, for instance. We're looking in Nashville and Cleveland. Now, Nashville has a lot of job growth, has a lot of population growth. People are moving there. Rents are rising. I think there's less risk 5 years down the road for somebody to collect rents in Nashville. Hence, cap rates are going to be lower. Things are going to be more expensive. And that's why in Cleveland, I'm just picking on Cleveland right now, it's a Rust Belt city. Population growth is not as strong. Job growth is not as strong. Rents may not be rising as much. It's going to have a higher cap rate. Things are going to be cheaper there. That's just the reality of it. And what you're trying to do is you're trying to find a market that you feel comfortable in with the future. If you're willing to buy Nashville at a 5 cap, you're looking at the cap rate today and you're trying to buy so you can actually add value to the property, add NOI to the property. So when you're buying a cap rate at 10, and this is getting ahead of ourselves, but I'm gonna talk about this real quick. When you're and you're a value investor, if you're adding $1 of NOI at a 10 cap, and you're adding $1 of value at a property with a 5 cap, you're getting twice the value, double the bang for the buck, doing the same amount of work with getting properties at a 5 cap when you're raising the value by $1. So you have to understand that. Now, the 10 cap property is going to cash flow more because this is cheaper property. It's going to cash flow more. Properties that have higher cap rates tend to have higher risk. That's why in the C properties that are 30 years and older, they tend to trade at a higher cap rate. What you need to do with these cap rates is you need to compare. Well, if you're in Cleveland and I'm buying a property that's 30 years old with an 8 cap, and all of a sudden a broker brings me a deal, 30 years old, very similar with a 7 cap, well, guess what? That 7 cap property on the face value, it's more expensive. Why would I pay more if the market in Cleveland's an 8 and the brokers bring me a 7 cap? I have to take a look at that and go, what are the differences? Well, maybe the 7 cap property is a little bit newer. Maybe rents are a little bit higher. Maybe it's in a more desirable neighborhood. So what you need to do is you need to use cap rates, look at them, and try to figure out how to actually use them and compare properties, compare markets. Are you comfortable investing in a lower cap rate market? as opposed to Nashville, as opposed to Cleveland. There's a lot of factors, but you have to understand what works for your investing strategy.
Keep in mind also that these things are typically based on pro formas. So a deal closes based on someone's pro forma and the cap rate that's built into that pro forma. So that's what's getting reported. So that's number one. And when you're looking at that, what does that mean? If it's based on a pro forma, you got to say, well, the 10 cap looks great, but what really matters is when the rubber hits the road and actuals are spit out. Because ultimately, that 10 cap property is probably going to have some delinquency. It's probably going to have some crime. There's going to be issues associated with it. So your real rate of return is going to be different than that pro forma. And the first thing that popped into my head when Gino said high cap rate versus low cap rate to me was, am I buying or am I selling? Because all things being equal, if it was the same property, obviously I want to sell at a lower cap rate and I want to buy at a higher cap rate. But that's just, from a perspective of what's in my best interest if all things were considered equal, which they're never going to be. So, Gino, I think those are all very great points.
And Jake, the properties, when I started investing 15, 20 years ago in duplexes and triplexes and quads up in Rochester, New York, they were using cap rates. I don't really think smaller properties, it's relevant to use cap rates. I was buying like 20 caps and 25 caps. I was like, woohoo. But then again, I'm buying Section 8. I'm buying really rough housing. So understand that. What's your strategy? And when you're looking at that, it's really, really important to understand what you're trying to do. Now, it's NOI divided by price. We held off. We didn't give the formula yet because we made to give you a base understanding. So if the NOI of a property is $100,000,
cap rate is the NOI divided by the value. Yep.
Thank you.
Or the price. Yep.
Yep. Net operating income. If your net operating income is $100,000 and your price or the value of the property you're selling it is $1 million, you take $100,000 divided by $1 million. That's 0.1. That would be a 10 cap. Now, if all of a sudden the NOI drops to $50,000 and you're $1 million, do the same calculation, and that's what you get. So I think that's how you're working it out. And what you do is just start playing with the numbers. And the reason why multifamily and people became exceedingly wealthy in this part of the market cycle, as cap rates are 8 and 9, all of a sudden real estate and multifamily, the money starts flowing there. What starts happening? Prices start going up on these assets because there's more demand. Cap rates are dropping, which is called cap rate compression. So if you're just sitting there holding the property for the next 10 years and cap rates go from 10 to a 7 and you've done nothing, you haven't done anything to the property, it's just the market, you've gotten extremely wealthy just from those cap rates compressing. And what happens is once again, cap rates dropping, your price or your value of the property is increasing. And can you imagine just sitting there over the years? And now what's going to happen as the market tends to soften, we're going to hopefully see a decompression where cap rates are going to start going back up. All of a sudden, they've gone down to an average of like 4.5 to 5, countrywide, United States, nationwide. Hopefully, they'll start decompressing because there'll be less demand for the asset. There'll be less money flowing into the asset. So prices will tend to drop, and hopefully, cap rates will start inching up for those of us who want to buy.
Yeah, and so a lower cap rate typically, and this is not always a slam dunk, is a safer bet. You're probably going to be in a better neighborhood, more stable. You saw just recently when they started printing a ton of money and they dropped interest rates, you also saw cap rate compression or cap rates coming down. There was more demand and people were hungrier for deals. So these are all things to consider. But gang, ultimately for ourselves, we'll look at cap rate, but I mean, it's not the end all be all, right? We are more so looking at cash on cash return. That's what's really important to us because we're buy and hold investors. If you're somebody that likes to do syndications and then sell out of a property, a low cap rate environment might be very good for you, especially if there's cap rate compression because you're going to be able to sell at a higher price ultimately. Gino, what you got?
Jake, that's a great point. And what I would say with that is when you're looking at it, it's only one metric. You're looking at cash on cash. You're looking at your debt service coverage ratio. You're looking at rent growth. It's one of the buy right criteria I think you need to focus on. You're looking at median income. You're looking at flood zones. But cap rate, understand that you need to know what it is in the market because when you're speaking to a broker, if you're in Cleveland and going, yeah, I'm looking for those 12 caps, broker's going to look at you and go, what's the matter with you? I haven't seen a 12 cap in 20 years.
I
So
don't
you
know,
have
it's
to
Cleveland. He might get on the
yeah,
other side of the tracks, right?
nowhere, bro. I'm just saying, you have to understand that. And, Jake and I are going to be going over this stuff in our next webinar. Go to jakeandgino.com/webinar. Sign up and register for the webinar. We're going to be discussing how we closed our most recent deal, the buy rate criteria, the manage rate, and the finance rate, which will encapsulate cap rates and cash on cash return. So go to jakeandgino.com/webinar. And the last thing I'll say about cap rates, go online, Google it, and you'll see 30 different answers, 30 different definitions. To me, it's basically, I'm going to say it's basically a rate of return. If I got a 10 cap, I'm looking to get my money back in 10 years. It's only one metric. And the most important thing is it doesn't include any debt. There's no debt on it. So that you're trying to compare apples to apples. You're trying to compare two properties that have no debt on them. And what do they look like? That's what the cap rate is used for.
Gino, we've said it before. It's the politics of real estate investing. Cap rate and real estate. People want to come and just start arguing and bickering with each other online and throwing stones and being keyboard warriors. So we'll leave it at that. But gang, the other thing is we're going to be detailing our deals at Multifamily Mastery 6. We're actually doing a presentation on some of the stuff that we've closed on recently. And we're going to be showing why ultimately cap rates are not super important to us as buy and hold investors. So we'll be going over that. And, look, it's like Gino said, it's NOI divided by value. It's a rate of measure used to estimate and compare rates of return on different properties. We look at it, but we're more driven by something we call PPU, which is profit per unit and cash on cash return. So that's our preference, but it doesn't mean we don't look at it. So just, like to see you at Multifamily Mastery 6 this October. You can go to jakeandgino.com/MM6. It's the financial vacation for smart people. It's the #1 real estate conference of the year. And we hope to see you there. So, gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's a G-Daddy, and we make it happen.
Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.